Hey guys, Rich Farmer here with KRC Realty, Property Management and Mortgage. This is another episode of Mortgage Mondays. I had someone reach out to me the other day and they were just curious and kind of a conversation. They're like, what drives mortgage rates? And when I started to think about it and the way I was going to answer him, I wanted to explain that, and I wanted to share with you guys as well that there's certain things in your control and certain things that are not in your control. The things that would be in your control would be, number one, would be your credit score. Obviously, the higher the credit score, it's pretty much common knowledge. The higher the credit score, whether you're buying a car, a house, or anything else, the better the rate. So also the product that you're looking for. VA and FHA loans typically have a little bit lower rate than a conventional loan. And the reason why is FHA and VA loans are guaranteed by the federal government. So whenever the federal government guarantees payment, and they do that in the form of funding fees and mortgage insurance premium and good stuff like that. So, but they are guaranteed. Also, the loan that you choose, 15 or 30-year loan or 3-1 or 5-1 adjustable rate loan. If you're in a 30-year loan, the risk of you defaulting over 30 years is higher than the risk of a 15-year loan. So you would expect a little bit lower rate on a 15-year, and that's how the banks price them out, because less risk of default. Loan to value, the risk of walking away. If you're putting 3 or 5% down, you're a first-time home buyer, you're putting 3 or 5% down, your rate's going to be a little bit higher than someone who might have sold a home and now they're 75% loan to value as opposed to 97%. And the reason why is if the guy or gal that only put 3% down, if they fall on hard times, they might walk away from that 3% equity. This might not be that much money to them, where if you've got a couple $100,000 in equity in a property, you're going to do everything you can to try and save that property because you don't want to lose it. You're either going to sell it or you're going to lose it, but the bank's not going to, you don't want the bank to take it back and you lose all the equity on it. So LTVs is a different thing. Another thing would be single family home or a second home. So let's say you have a single family home, you're here, living here in San Marcos where I'm at, and you have a second home out in the desert. Why aren't the interest rates going to be the same? If you go to the exact same bank, the exact same loan program, because they know if you fall on hard times again, or if something happens in your life where you can't make a payment, you're probably going to walk away from the second home before you walk away from the primary home. If you got a condo out there in Palm Springs and a house over here in San Marcos, and you fall on hard times, that condo is going to be gone, or you're going to walk away from it. So the banks realize that. So the type of product that you have as well, or the type of home that you have. So primary home is going to get a better rate than a second home. Things that are not in your control. As a mortgage broker, we're looking at unemployment rates, we're looking at GDP, we're looking at economic growth. And typically when the economy is doing well, rates go up. When the economy is doing bad, rates go down. And why is that? Because everything is driven by the 10-year bond. And when the economy is doing well, a lot of people take their money out of the bonds and they jump into the stock market. When they take their money out of the bonds, then the rates go up. When the economy is doing bad, people don't want the risk of the stock market, so they pull it out of the stock market, they put it into something a little bit more secure like the bonds, and the rates go down. Now this happens all over the world. The 10-year bond is traded around the whole world. Everyone's basically using the same vehicle when it comes to mortgage rates. That's why we have the coronavirus. Even though it hasn't hit us too much here in the US, China has just beat them up, right? And they're doing really bad. It's really affected the Chinese market. They've gone down significantly. And so you have a lot of people that are jumping out of the stock market over there, and they've jumped into the bond market. And look at where we're at today, 3.25 on interest rates on a 30-year fix. That's crazy cheap money. And that's happening because of something globally. So those things are not in your control. There's a lot that's in your control. There's a lot that's not in your control. If you have any questions about mortgage rates, what drives them, when's a good time, my perspective on where I think rates might be going over the next couple of years, I'd love to answer any questions and talk to you. I can be reached at our website, krcrealty.com. And again, this is Rich Farm with Mortgage Mondays, and we'll see you on the next episode.